Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thank you so much for being here today. Today we have episode number 27 with Prashant, and he will introduce himself in a minute. But for those, I know there are a few folks here that are their first time. Our goal here is to really focus on how to get into your first syndication. And if you've already got your first syndication, maybe how to get into your next one and get better at the next one. So we always try to bring syndicators who've been there before, and so for us to ask questions and learn from their experience.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
All right, so let's just go with some introduction. So again, my name is Marcelo Cazini. So my background is in IT and project management. I'm here in Houston, Texas right now. I'm a local CCIM member with all of the completed CCIM designation training. And in the real estate, I'm a multifamily investor. I operate my own commercial real estate. And I also, prior to I focus only on multifamily right now. And prior to that, I was involved with single family fix and flips.
So my name is Claudia Rubio. I think most of you guys have met us before, but I am a commercial real estate investor. We are both based out of Houston. We've been living here in Houston for 7.5 years already. Before we were in Colombia, where I was born, in South America. And that's where I got my architecture degree. And all my asset management experience comes from managing my own assets from my family, and then our own assets in Colombia with Martin. We used to manage all kinds of real estate assets like single family apartments, warehouses, lands, farms, like almost everything. And now we're here in Houston. We did our first syndication. We closed on our first syndication in December 2019, and we are managing our property here in Houston.
I'm Marcelo Rubio. I'm Claudia's husband. I'm an IT security consultant, and we have been in real estate for a long time together. And right now we're very focused on the Houston market, and we feed off of the energy and education from everyone in the ecosystem. So we love having these meetups and meeting new people every time.
All right, thanks, Claudia and Martin. Prashant, go ahead and introduce yourself.
Yeah, thanks a lot, guys. Thanks, Martin, Claudia, and Marcelo. Appreciate you having me here and looking forward to this interactive session. So a little bit about me. I'm currently based out of Dallas. I'm a co-founder of Catalyst Equity Partners. We are a multifamily investment firm. We own 700 plus units currently. Prior to that, originally, I'm from India. I grew up there, did my undergrad in engineering, came to the US, did my grad school here, and went on to work in the technology space. Spent about 20 odd years in the technology space, first as an employee, W-2, and then moved on to become an independent consultant. Then I started a consulting company. So I had a consulting company for about 10 years that I ran. And along the way, I always dabbled in investments. I invested in some restaurant ventures and land and single families. So I was in real estate since 2005, but over time, I realized that, single family was great, but it was difficult to manage and difficult to scale, at least for me. And we'll talk more about that. But I got introduced to multifamily in 2016, bought our first deal in 2017, and then bought 3 more deals after that. So currently we have we purchased total 4 deals over the last few years, but we've already sold one of them in 2019. So we currently manage or asset manage three properties that are in Dallas. So that's kind of our overview in a nutshell, and we'll go into the details of each of these aspects, hopefully along the way.
All right, thanks, Prashant.
Okay, so let's get started. Prashant, so you just mentioned that you already invested in real estate before multifamily, but what about multifamily attracted to you, or what attracts you the most?
Yeah, so I started, like I mentioned, I started investing in single families in around 2005, 2006 timeframe, and I kind of accumulated around 6 single families over time. And I'm not a handyman, so one of the worst things about single family was just dealing with tenant calls, broken toilets, issues, that I personally didn't know how to deal with. And that was, yes, we can call the maintenance guys and stuff, but that was the part that I didn't enjoy. I like the cash flow, I like the appreciation, and from an income standpoint, that was a good asset class, but I couldn't figure out how to scale it for all the reasons that I mentioned, right? So initially, I was really trying to figure out a way to sell all these, single families and just buy maybe a seven unit or 8 unit, complex, right? I just wanted to have all these units under one roof so that I could manage them easily. But in the quest to figure out how to go about buying that small, multifamily, I ended up at a event that taught about multifamily investing. And that was a weekend event, and I attended that. And one of the first thing they mentioned in that event is it's easier to manage a 60 unit than it is to manage an 80 unit property. And that was kind of an eye-opening statement for me, is that how can that be? And as I learned more about how this business worked, the third-party property management aspect, trying to consolidate all these units under one roof, and just the scale and how you can optimize on the revenue and expenses because you have that many units, just made sense over time as I started digging more into it. And that was in 2016. That's when I attended the event, and I was sold on that whole concept of buying multifamily, and also the concept of syndication. So I had no clue what syndication was until 2016. I had never heard about, I didn't even know that people like us could even buy these big apartment complexes, right? So the syndication concept, that's what I learned in 2016 in that same event. And, that's when luckily my wife was with me at that event, and both of us were sold, and you just decided to jump right in. And initially I really decided, I was busy with my technology business, so I decided to get into the business as a passive investor, right? Because I didn't have time to figure out how to be a syndicator. So I just thought I'll dip my toes in and start investing with others who were bringing the deals to the table. So we went in and invested in about 7 deals within 6 months, around 2,500 units. So we went pretty fast. And we liked the results. We saw how it worked. We kind of talked to a lot of sponsors and understood how they did, presented their deals, managed their deals, communicated with investors. So it was more of a learning experience for me, and I just wanted to make sure, I understood how this business worked. And after 6 months or so of investing passively, I decided to take the next step and become a sponsor. So that's when we started looking for our first deal. And then 3 or 4 months after that, we found our first deal and went from there.
Okay. So we give a lot of focus on that path from 0 to 1 to education, right? So you mentioned you approached this group, the weekend event, and you started learning from them. Besides that education you got on multifamily from that group, did you use anything else like podcasts, books, anything that you would recommend to someone starting out?
Yes, really all of the above. I mean, books, yeah, I mean, I read a couple of books, Dave Lindahl and stuff, but there's not a whole lot of books out there that are going to teach you much. I mean, the best way to learn all that, the best source for me was, meetup events. I went to a lot of meetup events in and around the city, and meeting other people who are in the business who've done this before, right? So talking to them and understanding how they did it. Podcast was definitely a great source. I mean, there's tons and tons of podcasts out there, focused on multifamily, right? So I was, for almost a year in 2016, I became a podcast junkie. I never watched much TV, and every opportunity I got, whether I was working out or going for walks, I was listening to multifamily podcast. So that was definitely a great source of, information for me. Bigger Pockets was another place that I visited quite a bit. That's a great community, online community where a lot of real estate investors, are putting out great information and communicating with each other. So I spent a lot of time just meeting others, talking to others who've been there, done that. And that was, my biggest source of information for me, to get the confidence to go to the next step, to take the next step, really.
Okay. So additional, we have a couple questions, but I'll push them a little bit until we get to more advanced on the basics. So when you felt you had the education and you were kind of ready to jump into syndication, I think the first strategy for everyone is sit down and figure out your team and all of that. Did you focus on any specific markets? Did you have any your partnership with Shane or anyone else at that point, or did you start on your own?
Yes. So I started passively investing first, and along the way I was, trying to build my team, right? When we talk about team, I mean, the legal, you need a lawyer if you want to get in this business, to try to connect with the people who are in this business, who do the legal work, property management companies, construction guys. So I was trying to build that network. And also along the way, since I was, already had a job and doing my technology stuff, I didn't have a whole lot of time to do it on my own. So I was open to partnerships, right? So I was meeting other people in the business or trying to get into the business to see if there's any synergies, complementary skills, if we have the same goals. And that's how I ended up meeting my partner, really. I don't know if you guys know Shane. He lives in Houston, but Shane is my business partner, and we really ran into each other at one of these events and started talking. And, for almost 4 months, we didn't really talk about partnership per se, but we were really collaborating. He was learning, I was underwriting deals, he was doing the same. And over time, we realized that, hey, we are heading the same direction. We had the same goals, and we had a lot of complementary skills too. He came from a finance background, he was a CPA. I come from an engineering and business background. So there was a lot of, skills that we could leverage up, from each other. And we just enjoyed working with each other. So we just decided that, why don't we team up and share the workload and, do it together. So at first, we just decided to go after this first deal. We didn't really talk about, starting a business or anything like that. We just said, hey, let's just do this first deal, see how we work together, and that's really how this partnership started. And then going back to your question about criteria, right? So once we decided we're going to partner, we defined our criteria, which was, what kind of deal, what is the size of the deal we want to go after? What are our sub-markets that we're going to go after? And then what is a team, what are other metrics that we want to look at, right? What any specific, characteristics of the deal we want to look at. So we wanted, so what we had decided was we wanted something in the 100 unit range, because that just made sense from a property management and, the economics perspective of the deal, right? And then since I was in Dallas and he was in Houston, those were the two markets we were looking at. It just made sense to just look in our backyard, right? Why go far away? So I was looking in Dallas and he was looking in Houston, and we ended up finding the right deal with the right characteristics in Houston, in the Houston's suburbs, Alvin, Texas, to be specific. So it just met our criteria. It was a 125 unit deal, $5.5 million price tag. It was the right size for us. It was going to be a $2 million raise at that time. We had never raised money before, so 2 million sounded like a reasonable number to try to go after between the two of us. And yeah, I mean, it just worked out, right?
How long did it take for you guys since you started looking for deals to find that first opportunity?
It took us a while. So it seems from the outside that, you see all these people buying deals, putting it on Facebook, etc. And it just seems like an easy business, but it's really not. I mean, we had to go through probably 80 to 100 deals before we found the deal that fit our criteria. So we had underwritten almost, 80 plus 100 deals, like I said, across both the cities. And this was probably the 101st deal that met every checkbox, that checked all the boxes for us. And it happened to be an off-market deal, so there was a little less competition. So that, worked out for us. So we started around November of 2016 looking for deals, and it was March of 2017, April of 2017, or actually May of 2017, May of 2017 when we actually got it under contract. So it took us that, few months to get the first deal under contract.
Yeah, I get that question all the time, like how difficult it is to buy a deal. And it's not difficult at all, right? You have to find the one that you want to buy.
Yeah, exactly.
Okay.
So, I mean, you got to be very specific with your credit. I mean, there's a lot of deals. I mean, we come across a lot of deals, but half of them we don't even go past the first level of underwriting because it doesn't meet our income criteria for that, for that 1 mile radius, or something specific about the property that we don't like, or maybe there's not enough upside opportunity to get the returns that we're looking for, right? So you got to go through a lot of that and be selective on what you buy if you want to succeed in this business.
So Prashant, you mentioned 80 to 100 deals that you've underwritten, and you also mentioned first level of underwriting. And I know there are some questions on the chat here about underwriting. So can you walk us through how do you do, what are you looking at that first level? How do you do like a quick analysis to go through 80 to 100? And then after you go through that quick analysis, when you go to the second level of underwriting, what are you looking for? What have you done in terms of increasing revenue, decreasing expenses? So talk us through maybe your underwriting process so people can learn how, and then tagging along with that, what are some characteristics of a good deal that you can?
Okay, so yeah, no, absolutely. That's a great question. So before really, we get into the actual number crunching, let's walk through the process, right? So you get, assuming it's a listed deal, you'll get a offering memorandum and the financials, sent to you, right, from a broker. So for us, location was the biggest criteria. We were very, very picky on where we want to buy. So we had already within, let's say Houston, we knew there are certain pockets that we didn't want to go in, and certain areas that we were open to look at, right? So location was our first criteria. We didn't fit that, and also the income in that location, right? So both went hand in hand. So our criteria for income was anything over 40K median income. So if it fits that, then you take it to the next level. And then you look at, actually, when we started, we were focused on C-class properties. So we were looking at 60s and 70s, right? So, anything over 80, we weren't ready for it. at that time. So anything that 60s and 70s with a value add component to it, meaning that if we saw that let's say that it had, classic interiors and the owner hadn't touched it for a long time, so where we could go in and upgrade the interior units and increase the value, that was attractive to us. We looked at expenses, if there's any opportunity to reduce some expenses, those are the things we looked at. So initially, the first cut, what we used to do is just take the OM and underwrite based on what the broker was telling us, right? So the broker has a story, they sell you the deal, they have their own underwriting. So we used to just first underwrite with what the broker is telling us and see if, it doesn't make sense. And then start to go deeper and then start stripping off some of the fluff that the brokers usually end up putting, right? They'll say that you can make another 100K and, extended patios and, put this covered parking and you can charge $80 and stuff. So that's where we dig deeper and then start making, realistic assumptions to see, okay, what can we do and where can we add value to a particular deal, and then let's see what makes sense. So it's kind of on a typical deal, we usually have 7 to 8 versions of underwriting that we go through, before we decide, okay, do we really want to pursue it? Usually we go to version number 3 before we even tour a deal, because we don't want to waste our time nor the broker's time trying to tour a deal that may or may not even work for us, right? So you got to go through at least a couple of iterations of underwriting to see, okay, is it worth it? If we can get to reasonable returns. In our case, we had a 50%, let's say, if we can get to a 50% return on our version 3 underwriting, maybe we can go and check out the deal and see how we can take that 50% return to an 80% or 90% after we know more about the deal, right? So a lot of the deals used to get filtered out in version 2s, hey, it doesn't even work. If we can't even get to a 20% return with just the paper information, we don't want to waste time. Let's move on, kind of thing. So back 3 years ago, it was easier to do kind of a back of the napkin analysis, which is a term you may have heard a lot, right? Back of the, just look at high level income, high level expenses, see if, the pricing makes sense. It's getting a little more difficult now to do because you don't have rent growth, market rent growth happening. So you really have to dig into the deal to see what the opportunity is. Just on the surface, it's very hard, at least on the income side, to figure out, what the upside is. On the expense side, you can make a lot of assumptions, right? You can say, $1,200 per unit for payroll and $450 per unit for repair. I mean, those are standard assumptions you can make on most of the deals. But on the income side, you really have to dig deeper to understand where is the deal now, what has the seller done so far, what are the comps doing around it, what are the neighboring properties offering, is there any opportunity for us to take this property you're looking at to that higher level comp that you may have next doors or not, right? And what is the rent premiums that you're going to charge to increase your income? So you got to dig a little deeper, unfortunately, nowadays to do your first cut. It's very difficult to do a back of the napkin on any deal nowadays to, figure out whether it's a good deal or not. There's a lot of hidden opportunities that you may not know of until you dig into it. So hopefully that helps. It was kind of a long-winded answer, but hopefully that helps.
No, that's good. Now, if we look at that question from an LP side, so Marcos was asking, you mentioned that you had invested in maybe 15 deals as passive investor. So walk us through your due diligence process if you're looking at a deal now as a passive investor, and how did you evaluate, how did you select those deals, and was it only gut feeling, or was it some something specific on those deals?
Yeah, so I'll be honest. I mean, the first 8 or 10 deals that we invested in, a lot of it was gut feel because I didn't know what I was doing, right? And I was really investing with the sponsors more than the deal, at least in the first few deals that I did. I was networking a lot, like I said, I was meeting a lot of people, and every deal that I invested in, I had met the sponsors, I had met them in person, and if I got a feeling that the sponsor knew what they were doing, they were honest, and I felt they were gonna be, communicating with me on whatever is going on in the deal, that was my criteria for investment. Yes, I did look at the deal high level, I did look at the location, but I didn't focus too much on the details of the numbers and the projections at that time. I've obviously learned a lot over the years, and now I'm in 4,000 units total passive, by the way. So I still continue to invest, but now I'm a little bit more picky on what I see. So a couple of things I look at nowadays is obviously still the sponsor matters to me, but if a sponsor is projecting revenue growth of 4, 5, 6, 7%, I want to know what the CapEx plan is, right? So that's my first thing that I'm going to look at. They're going to increase all this revenue, charge more rents. On what basis? Are they going to spend money at the property and then do it? So that story has to match, right? So that's the first. And because I see a lot of deals where they have this huge revenue increase, but they are going very light on CapEx. So that's the first thing I normally take a look at. What is their CapEx? What are they exactly doing to the units? And, what are they expecting to get? And then other things can be, how tight are the expenses, operational expenses, because after looking at so many deals, underwriting so many deals, I kind of sort of have a general idea of what a typical C-class asset needs to be run efficiently, right? So you can glance at the expenses, if they're around 6,000 a door for a C-class, that's kind of a reasonable ballpark, but you can dig deeper there. And then, cap rates, right? That cap rates can swing the total return number significantly. What is the exit cap they're using compared to what they're buying at? Generally a 10 basis, 15 basis expansion every year is reasonable in today's market. It used to be 20, 25 basis every year. So those are a few things, basically what you're trying to do as a passive is making sure that it's conservatively underwritten, deal, right? You don't want to go too tight and run out of money, in year 2, and then there's a capital call or other issues and you can't execute on the full business plan.
Mm-hmm. Yeah, that makes sense. Because most syndicators will always tell you, oh, I'm a conservative underwriter, but there's different degrees of conservative underwriting, right?
Exactly. The thing is, you're not going to find any deal. No sponsor is going to come and tell you that, hey, invest in this deal. This is not a great deal, right? Every deal is going to be an awesome deal. It's going to be a passive investor job to do the due diligence, and you don't really have to get too paranoid about every little number there, but just have a few key things that you look at, right? What is the revenue growth that you're expecting? 3 to 5% or even 7% in some cases is reasonable, but if somebody's projecting 15% revenue growth year 1, the question should be, okay, how exactly are you planning to get it, right? And if the sponsor can explain it to you, that's great, right? If they have a clear idea of how they're going to do it and why they're going to, why is it, why was the previous T12 50%, 15% below market, then fair enough. But there has to be a story. It has to make sense for you to be able to invest in that. Don't just, one big mistake I've seen people make is look at the total return, right? You look at 2 deals, hey, this one has got higher total return, I'm going to invest in this one. A lot of times the other deal might be a better deal because it's underwritten, a lot more conservatively. You don't want to, because all these numbers that are presented are really projections, right? They're not promises. These are not guaranteed numbers. These are just projections based on a lot of assumptions that we make as sponsors. And as a passive, you want to get comfortable with the assumptions that were being made to generate those potential returns that are being presented.
Yep, makes sense. Now, a lot of folks that come to our meetup, they're looking to syndicate their first deal, right? And you even mentioned that now it's maybe a little bit harder to do the back of an applicant analysis. What would be your best advice for someone looking for to syndicate their first deal right now, given where we are on the market cycle with COVID? And so what would you recommend for somebody starting now or looking to do their first deal now?
Yeah, let me address your COVID comment there first. So when COVID hit, all of us multifamily people are, in every business, right? Every asset class, we were all panicking that is the end of the world, and multifamily cap rates are going to go up, and the boom is over and everything's going to crash. But interestingly, it's the opposite right now. Since about September, because the interest rates have gone down, and overall the multifamily data has been very positive compared to a lot of asset classes. So there's a lot of money being put into the multifamily, asset class. So multifamily is here to stay. It's going to get more and more competitive. Prices are going to keep going up for the next, few years at least. So I don't think COVID has changed anything. It's made things more competitive. The only one thing I would say COVID has helped is separate out the good locations and the good deals from the bad deals, right? So the properties that were not well located have suffered more through this COVID experience, and the properties that were well located had done phenomenally well, and better than even pre-COVID in some cases. And Marcelo, you're in one of the deal, right?
Mm-hmm.
Marcelo is one of the investors in one of our deal, and we are killing it. 99% occupied. Just because we bought in a great location, we had great demographic, and it just, whatever criteria we had pre-COVID has helped us navigate, or survive through COVID. So that's, the COVID thing is we'll get through that, I'm sure, and so that shouldn't impact you guys, if you're starting off. But the few things that you need to do is, obviously, first is education, right? Make sure you get your education, whether it's through podcasts or attending an event or whatever you choose to do. But you need to learn the language. When you're talking to brokers, you need to learn the language. You need to understand the terminology that gets used in this business, so that when you do talk to a broker, they take you seriously, right? They know that you've done your homework, you understand what you're trying to get into, right? So get your education. Then number two, I would say, is build your team. So build your team is identify your legal team, property management team, your construction crew if you have one, but find out who you're going to be working with when you get a deal, because a lot of times even the lender is going to be one of the biggest team member, right? Because a lot of times when you're having conversations with brokers, when you go to them saying, hey, I'm trying to get into this business, get me a deal or get me a lead, those are the questions they may ask you. Who's your lender? Who's your property management company? So you should be able to have, be able to share that information. And then once you have your team, I would say build your network, because, once you get a deal, you're going to need money to close a deal, which is you can get your own money, or if you don't have the money, if you're going to trying to be a syndicator, then you need investor money. So the investor relations should be happening on an ongoing basis, whether you have a deal or not. And, for example, last year, COVID times, we haven't closed a single deal, but we've been out there, whether it's on Zoom or whatever, continue to build relationships with people, to build our investor database, because if and when we do get a deal, they're there. We've already talked to them. They know what we are doing. They know us. So it becomes much easier to present a deal to the right people and raise the money at that point. So education, build your team, and continue building your investor network, I would say it would be your first 3 steps.
Okay. Yeah, great strategy. We have a couple quick questions here on the chat. One, how did you identify good construction companies or repair crews?
Just referrals. I mean, once you start navigating through all these meetups and meeting people, you can get all these referrals. That's how we build our database of all these, service providers, right? We just went to meetups, we talked to other people who've done it, asked them who do they use, and then we talk to those companies ourselves. Some companies we like, companies we don't, and we just filter out who we want to work with, and that's how we build our database over time.
Okay. Then Jay is asking, how do you identify rent comps? Are you using the ones on the OM mostly, or do you choose your own?
The OM is a good start. So we definitely look at them just to kind of get an idea, but we also now we have a subscription to a software that allows us to do the rent comps, so we can pull up data on other properties and pull up the rents. And recently we've gone one step beyond. So we have an operations manager who we hired. So she actually calls all these properties and verifies all the rents. And that's how we do, some real world rent comps, that we get confidence on. And we used to do that before we had the operations manager. I mean, I used to personally call some of the, comps and confirm whatever is presented in the OM is valid, right? So you don't need the software. Software just makes it easier just to do it with one click. You can always pick up the phone and just call all the neighboring properties and get the rent comps. I mean, back then, we used to drive to these neighboring properties to just get a feel of what they're offering, in addition to actually getting the rents, right? What amenities they have versus the property that we are buying, to get a, visual on what we are competing against. So you can you can do it over the phone or physical driving to the properties. Yeah.
Okay. Jasprit is asking, on that first deal, your first syndication, I think that was the one in Houston. Again, what was the number of units and the pricing maybe per unit?
Yeah, so it was 2017, and that was a 125 unit property, and we bought it at 48 a door.
Wow.
That price was unheard of. Yeah, right. When we started our contract, it was a 7 cap. When we closed the deal, it was a kind of a long process, and it's a very complicated execution we had. But it was almost a 9 cap when we closed on it. So the revenue it was a $5.5 million price tag.
Wow.
It was a slam dunk when we bought it, but we had a lot of challenges all through closing, and even after closing as a first deal. So it was an interesting project.
How much did you sell per unit?
We sold it in 2.5 years for $69 a unit. So we had around a 25%
wow.
Annualized return for our passive investors on that one. So it was a 5-year hold when we went in, but we just got an opportunity to sell it in 2.5 years, and investors all voted for it and said, okay, let's just lock it in and cashed out.
Yeah. Now you mentioned that you had challenges in that first deal. What were your biggest challenges in that process from 0 to 1?
This was, um, we had every possible challenge that anybody can imagine on this deal.
I was gonna ask, were they because it was an off-market deal that you had more challenge? Would you
No,
attribute
no.
it to that?
No, not at all, not at all. I mean, I think the off market had nothing to do with it. It was just bad luck. You know, I don't know what, it was just some jinx on this particular deal. But basically, I think it all started, you know, first of all, the seller the seller who was selling it to us, he was a very difficult seller. And you run into those kinds of sellers, you know, occasionally, right? I mean, they're just picky, their contract negotiation, they want some stuff in the contract that is unreasonable. And so it took us almost 2.5 months. Usually it takes 2 to 3 weeks, you know, tops to get in a contract, right? Because everybody's motivated to get in a contract and move on. It took us 2.5 months to get on a contract. So that was our first challenge. The seller was very unreasonable, you know, hard money wise and certain terms and stuff. And then we started the process to go to closing. And in the middle of closing, we were trying to close October of 2017. And if you guys in Houston remember what happened around that time, Harvey hit, right? So a month and a half before we were closing, Harvey hit, and everything in Houston was, a lot of properties got hit. Luckily, this property did not get hit. We didn't have any water damage or anything, but in that process, all the lenders were freaking out because all their properties, a lot of them were underwater, there was a lot of insurance claims and et cetera. So we were 3 weeks from closing and our lender decided that they needed to do another inspection on the property. We were already done with all that stuff. We had done with the inspection, we were ready to close. Because Harvey happened, they said, you know what, we want to do another inspection just to check if your property has water damage. And they came in and the same inspector who had passed this property before, they came in and found some mold in some bathroom, had nothing to do with Harvey, but at that time, anything related to water and mold was a bad word, and they freaked out and they said, you know what, we can't close on this deal. We saw mold in one of the bathrooms, and 2 weeks before they backed out. This was an agency lender, so we were trying to go agency route, non-recourse, right? And because most of you guys who are trying to get into multifamily, there's recourse loan, there's non-recourse loan. You want to go the non-recourse loan route because that way you're not personally liable, for the loan, right? The loan is written against the property. So we were trying to go the non-recourse path, and they backed out. And so 2 weeks before closing, we had two choices: either return all the money to investors, and we've already spent 8 months of our lives trying to get this deal and close on this deal, or find a way to close it. So luckily, a different lender came to our rescue, and we closed the deal using the recourse option. That was the only choice we had. We had to go a recourse route, so we were signing on the loan. Our net worth and liquidity was on the line. We said, you know what, we like this deal, let's do it. We signed it, and we closed on the loan. And at that time, had a lot of sleepless nights as a sponsor. First deal, you don't know what you're doing. You got all these investor money, and you're signing on a $5.5 million loan. It wasn't $5.5 million, 80% of that, right? A little over $4 million. So that was a very traumatic experience for a new sponsor.
Wow.
But we did it. We signed on the loan, we closed on the deal, everything was fine. And then our first property management company that we hired turned out to be a not so great property management company. So we had to fire that property management company within 3 months. Then we hired another one. So this first property management company was a small company, and we intentionally hired the smaller company because we thought we would get a little bit more intimate, hands-on kind of management company on this deal. So our intent was right, but they couldn't deliver. They just didn't have the processes in place. They didn't have the sophisticated, the software or the systems in place to execute well on this deal. And we saw they weren't heading in the right direction. We got rid of them. So we decided to go the opposite direction. We said, we want to hire the most experienced company that we can find, because the first one, we thought maybe we made a mistake here. Let's go to the other. So we hired another company that had 40,000 units under management. One of the biggest companies in the country, actually. I'm not going to name names here, but so we hired them. Turned out they were, again, not so great. And in fact, they were even worse than the first one. It's not that they were bad as a company, but it's just that the people they put on this property, they weren't up to par, and they just did not perform. So we had to fire them month 8, and then we had to get another property management company. And literally at that time, Shane and I were traveling on our day jobs. We had a full-time jobs, and we were putting another 30 hours a week on this property, trying to roll up our sleeves, doing all the work, overseeing the property management company, and making sure our business plan gets executed. So it took a lot to navigate through those challenges, but we were committed. We were all in. We said, no matter what, we're gonna make this a success, and we turned it around eventually, and the end result was pretty good. So, this is not a typical scenario. I don't want to scare all the new guys who are trying to get into it. It's just, if you have several deals that you do, you're gonna run into some problems here and there on every deal, right? It just our bad luck that all the problems happened on this first deal. So we had a crash course in multifamily on our first deal.
Manish, I think you were raising your hand earlier. Are you still there?
Hey, Manish, I don't know if we already answered your question, but go ahead if you still have one.
Yeah, I'm here. Can you hear me?
Yeah.
Okay. Hi, Prashant. Thank you for sharing all the insightful information. Really appreciate. So my question is, you mentioned like you fired the property management companies a couple of times, or you were not happy. So is there any contract been signed with the sponsors with them, or it just the fire and hire kind of thing with them?
No, it's usually a 30-day out on both sides. So, and that's part of the negotiations you got to do up front. So some property management companies might have a 6-month clause, but we always insist that there's a 30-day, not more than 30-day clause in our contract. So
okay,
we can exit pretty easily.
Okay, and just my follow up. So you said like it's not the company but the people who are there on the property were not performing. So is the compensation to the property management is anything related with the performance of the property as per the sponsor plan, or they don't work according to the sponsor business plan?
Yeah, so they property management companies get compensated by the revenue they generate, percentage of the revenue they generate, right, every month. So it's usually anywhere from 3% to 3.5%, depending 3% to 4%, depending on the size of the property, right? So they just take that piece of the, the top line revenue, no matter what.
Yeah, right. No, yeah. So thanks for that info. But my question was more like, is there any clause or condition you put, like if you're not matching your business plan according to this much up to this milestone,
No,
then we're gonna, no, okay.
no, they can't, they don't do that. It's straight, straight revenue compensation. No property management company is gonna guarantee anything. You just hire them and oversee them. That's your role as an asset manager.
Okay.
And, sometimes it works, most of the time it works. Once in a while you kind of run into these situations. So I don't want to, make it sound as bad as it was for us, but most of the time it does work.
Okay, got it. Thanks.
So we have another question from Jaspreet about the raise in your first deal. Did you raise from friends and family, or how did you find?
Yes, yeah. So the money raise part was definitely, very kind of a scary experience, right? I mean, we've never done it before, never asked for money from anybody ever in our lives, and here we are trying to, raise $2 million plus. So it was. Honestly, we tried to keep friends and family out of it, the first deal, because that was our first deal and didn't want to have any relationships in that. So it was, our network that we had built over time in this multifamily business, right? So it wasn't any close family at that particular time, even though a lot of them wanted to get in. We just felt that let's keep it that way. And so we just raised money from the contacts, and they were friends that we had developed over time, but no family was involved. But since then, all our future deals, all our families and all our deals, a lot of our close friends are in most of our other deals. So
And that one was a 506B, right? With some
we've done all 506Bs. So far, for all you new guys, there's two ways to raise money. So one is a 506B, SEC 506B, which is you can raise money from accredited as well as non-accredited investors, but the requirement is that you got to have a pre-existing relationship with them. So I gotta know those people before I can raise money from them. The 506C route, which is we can solicit that, you can put it on Facebook or anything, and we can raise money from people we don't know, but they have to be accredited. So we haven't done any 506Cs just yet. We do only 506Bs. We have done only 506Bs so far. We may do 506Cs moving forward, but so far we just do 506Bs because a lot of our friends are not necessarily accredited, and we want to, let them participate in our projects.
Okay, so HP asked a while ago. I'm sorry, we're taking longer to take the questions, but what are the average minimums these days as passive investors, like returns?
Yeah. Like what?
Yeah. So. The returns, or
I think that's what
I think at that time we were talking about the typical returns. So what do you think a passive investor right now should be seeing as an average in typical deals out there?
Yeah, nowadays it's anywhere from 7 to 10% cash on cash with a 1.7 to 2x multiple, right? 14, 15% IRR on a 5-year hold. So that's typically what you see. And the older the deal, you can probably end up getting higher cash on cash. For newer asset types, if you're trying to buy 80s, 90s, 2000 product, is usually lower cash on cash return because, the returns are, related to risk, right? So the more risk you have, the higher returns you can expect. So the older deals you get, you tend to have higher returns on the older deals than the newer deals. So 7 to 10%. That's the typical cash on cash. Yeah.
Thanks, Prashant. Yeah, that's what we're seeing. And then another quick question we have here: what value adds did you do to your first property?
So the first property, the seller had held it for 5 years or so, and they had upgraded 30% of the units. So 70% of the units were what we call classic units, standard carpet and white appliances and stuff. So our business plan included taking those, the classic, a percentage of the classic units and upgrade them with vinyl plank, black appliances, fixtures, the standard, upgrade package that we typically do for a C-class property, right? It usually costs around, $4,000 a door to do that. And we were able to charge around 125 in rent bumps on that. So that was our interior plan, and there was a lot of exterior opportunity too. So the property was not very well maintained by the previous sellers. So we invested, a few $100K to just, do some curb appeal type of stuff, new signage, a little bit of accent paints, some playground stuff, clean up the parking lot type of stuff, and just kind of spruce up the exterior to make it a nicer asset and be more competitive in the submarket to charge the premium rents that we were charging. So our budget was around 4,000 a door, all in, going in for that property.
Okay. I think we have enough time for the last question. We're running a little bit over. Marcus was asking if you can provide any specifics on what was going wrong with the very large property management company that you had to get rid of.
Well, it was mostly accounting related that we found out. I mean, basically, they were not booking things, they were hiding stuff. There was a lot of accounts payable that was not recorded, so our reporting was all getting messed up, right? So
that's what you get with a partner as a CPA, right?
Yeah, exactly. I mean, that's why my partner, his CPA skills became handy, right? So he was digging into financials, and we uncovered a lot of things that we didn't like, and we had to fire those guys. But that's one thing I would recommend, that the new guys getting in, a lot of us are not from accounting background, so trying to learn some, at least trying to understand how the books, understanding the books, P&L statements, balance sheets is a very important skill, because even though you're third party managing, you are the one who's going to be overseeing those things, and you should be able to identify any issues that, at least some major, issues that you might see there, right? So, I mean, I'm learning that still. I mean, I had some experience from my business, my business that I ran, but that's a very valuable skill to learn. If you have an opportunity, I would say invest some time in, learning that part of the business.
Yep, that's great advice. So I wanted to share with everybody that if you go to our Multifamily 0 to 1 website, you can sign up to our YouTube channel. I also posted in the link there. I know some of you had to join a little bit later today, and maybe you missed the first part of the meeting. So typically within a week or two, we have this meeting posted on YouTube. So if you join the YouTube channel, you're always notified when we post a new meeting. And I also want to mention our next meetups. We typically meet always on the first and third Wednesday of every month. I know we had to move it to this week because of a multifamily event last week. So we're going to be meeting back to back. So we're meeting today and next week. So next week we're focusing on, I know several of you were asking questions about from a passive perspective. So that's the focus of the next meeting. So feel free to bring your passive investor questions. That's where we typically bring a experienced passive investor, and we can go into a lot more details in terms of what they're seeing, how they focus on, what they what they look for as a passive investor. And then back on March 3rd, we're going to have another edition of how to get from 0 to 1 as a syndicator. And I do want to thank Prashant, and I want to share his email address there. So Prashant, hopefully it's okay for folks to contact you if they have any other questions or if they're looking for information from us to try to locate a syndicator. So thank you so much for your time.
Absolutely. No, thanks a lot, guys, and enjoyed the conversation. And yeah, feel free to email. Love to help. Love to share anything, you need to know.
Yep.
We really enjoyed it, Prashant. You gave us a lot of great information, and we will have gone all night.
Same as we told Shane, we're going to have you back in a few months.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.